Greetings, everyone, and welcome to today's Food Supply Chain Guaranteed Loan Program webinar. Thank you for joining us today. And with that, I would like to turn the presentation over to Rural Business and Cooperative Service Administrator, Dr. Karama Neal.
Thank you so much, Taylor, and thanks to all of you for being here and for your interest in the Food Supply Chain Guaranteed Loan Program. We're so pleased to be able to share with you more about this new program and to work with you to ensure that meat and poultry processors and others in the middle of the food supply chain have access to the capital that they need to increase the capacity of the food supply chain and make it more secure, diverse, and resilient. I'm Karama Neal, Administrator of Rural Business Cooperative Service, and I'm joined today by several of my colleagues who you'll hear from shortly. Know that we welcome your feedback, your questions, and your engagement, and so we'll share our contact information later in this session. Next slide, please. As we all know, the pandemic exposed and exacerbated numerous vulnerabilities in America's food supply chain, creating extreme disruptions. The reduction in meat processing capacity is just one example of the food supply chain bottlenecks that affect small and mid-sized farmers. But we're seeing bottlenecks and brittle systems for a variety of foods, particularly in the middle of the food supply chain. In response to these and other constraints in numerous systems, in July, President Biden issued an executive order promoting competition in the U.S. economy. Given that and the funding provided by the American Rescue Plan Act, right now we have a once-in-a-generation opportunity to ensure that farmers and ranchers have access to better market choices and to build out our local and regional food systems. One of the ways we are responding to this opportunity is through the new Food Supply Chain Guaranteed Loan Program that we're here to talk about today. USDA is using $100 million in funding from the American Rescue Plan Act to back more than $1 billion in guaranteed loans to help finance working capital, facilities, equipment, and other investments in the middle of the food supply chain. Specifically, activities such as aggregating, processing, manufacturing, storing, transporting, wholesaling, or distributing food. This is just one of the vehicles USDA is using to strengthen the food supply chain by increasing its capacity and making it more secure, diverse, and resilient. Next slide, please. We are now accepting applications for this new Food Supply Chain Guaranteed Loan Program from lenders to guarantee loans of up to $40 million to help eligible entities expand meat and poultry processing capacity and to finance other food supply chain activities. We're offering a 90% guarantee to incentivize lenders to provide fixed interest rate loans to eligible borrowers. You'll hear shortly about how to access this new loan program, new loan guarantee program. We also encourage you to explore our website, rd.usda.gov/food supply chain loans, all one word with an S at the end. There you'll find additional resources, including a training video for non-regulated lenders and a recording of the recent finance forum sponsored by USDA, the White House, and Georgetown University, and featuring Agriculture Secretary Thomas Vilsack, Deputy Director of the National Economic Council, Samira Fazli, and a panel of lenders like you. Next slide, please. Given these events and this early significant investment, the priority the administration is placing on the food supply chain is clear. Because of the need in the meat and poultry processing sector, we've placed special emphasis on processing plants, mobile slaughter facilities, butcher shops, and other entities that increase the meat and poultry processing facilities. 19% of the funds in this new guarantee program are reserved for meat and poultry processing projects. Our other priorities are economic recovery from the COVID-19 pandemic, equitable access to rural development programs, and increasing the resilience of rural communities to the impacts of climate change. These priorities are also relevant for this program and for other rural development programs. You can learn more about these priorities and how they are used at rd.usda.gov/priority-points. These links should be in your panel. We're excited about the kinds of projects that will be used in this program and how borrowers, with the support of those of us on this call, will build capacity in the food supply chain and make it more secure, diverse, and resilient. To that end, again, we invite you to visit rd.usda.gov/food supply chain loans to learn more. In the meantime, I'll turn this over to my colleagues, starting with Mark Mizinski, Deputy Administrator of the Rural Business Cooperative Service at USDA. Mark?
And thank you, Dr. Neal, and welcome to all our lenders and stakeholders. We're glad to have an opportunity to connect with you today to share some information about this new program, about the Food Supply Chain Guaranteed Loan Program. We're going to spend a little time today with an overview of the program, try to drill a little bit into the program details, especially the kind of the key points of the program that you would need to know as a lender. We'll talk a little bit about the process. We have a little bit of a different application process for this program than our others, so we'll spend some time on that. And then, of course, spend all the time we need to address questions and answers. And again, for those of you that maybe had a little bit late connection and missed the introduction of this, in the chat box or in your control panel, there's a chat box, a questions chat. As we're going through, if you think of questions, if we provide some information and it wasn't quite clear or that led you to wanted to drill a little further, feel free to drop a question into the chat box. We'll address all that we can today. If you have some particular questions, very specific, either project type questions or areas that might take a little bit more one-on-one, we'll circle back to you and address any other comments or questions that we need to go forward. But again, feel free to use the questions in chat as we go forward. The program itself is going to be administered through the notice that was published now a little over a week ago on December 9th. And this slide does have a link. It's an active link back to the Federal Register. So the notice of funding opportunity is inviting applications, opening applications, but that notice also contains, I guess, what I would refer to as the regulations of the program. Our other guaranteed loan programs, we have go through a rulemaking process and we have rules, regulations stood up. This program will not. So we're using simply the notice that was published as the regulation for this program. So we'll walk through some of those, again, the key highlights through the presentation today. As a reminder, and I think you already heard probably twice already, but we'll have it probably a couple more times in this slide deck. As far as where to find more information on the program, we have a web page stood up for this program. So always feel free to go to that, and we'll provide you a little bit of more insights as to what that web page includes here as we wrap up the slide deck. I want to go to the next slide, please. So again, as a quick overview, and as Dr. Neal noted, this program will support over $1 billion. It's close to $1.4 billion in loan guarantees. That's the amount of loans that we'll be able to guarantee, the total amount of loans in this program. So just under $1.4 billion. We are setting aside some funds, basically a reserve of funds for the first several months of the program to focus on the initial processing of meat, poultry. Again, that's a reserve of funds. All of the other types of applications, all other projects regarding the food supply chain are eligible and will be processed during this timeline. It's just that we want to make sure that we have some funds reserved for the processing of meat and poultry supply. As we noted, applications are already open. So the day we published the notice is when we opened applications. And we'll continue to receive applications on an ongoing basis. And as applications are received, we'll process. We'll continue to accept applications until we reach the maximum that we're able to guarantee in loan dollars. Now the applications, and again at the end of this, towards the end of the presentation, we'll provide a little bit more detail as to the process. But really, applications are submitted by commercial lenders to USDA. We do not work directly with the borrower or the project. That's through the commercial lender. And the lender is responsible for completing your underwriting and approval of the loan as you're submitting in that request for the guarantee to us. And again, we'll walk through some high level as to those requirements, but note that the notice does have the detail as to the full application materials, the process that's needed to process applications. Our approval of a loan results in basically obligating towards to the funds we have set aside. We evidence the approval through a conditional commitment. So we issue a conditional commitment to the lender, indicating approval of the loan, laying out the conditions for the guarantee. And unfortunately, we have a little bit of a delay in being able to approve and issue conditional commitments. We cannot start that process or actually sign off on conditional commitments until February 7th. There's a 60-day notice to Congress to standing up this program. But we think that the 60-day isn't going to be a big delay. We know it's going to take lenders a little bit of time to put applications together and submit applications. Again, we'll start receiving and reviewing applications. We just can't sign off until February 7th. I do want to highlight that one of the major differences in this program compared to others that we operate and administer here at USDA Rural Development is this program is not restricted in geographic areas. Many of our programs are restricted to rural areas and rural communities. This program is not. So the project can be located in a rural area or a non-rural, an urban community, anywhere in the US or any territories. All those areas are eligible for the program. Okay, next slide, please. Just some quick highlights as far as the loan terms, just to establish what the funding or what the individual loans can look like or maximums. So the loan itself can be up to a $40 million loan amount that we can guarantee. We do not establish a minimum loan amount, so it can be ranging from small loans up to 40 million is the maximum loan amount. We will guarantee either an 80% of the loan or a 90% of the loan against loss. And as you see in our slide here, the 90% would qualify as a guarantee if that loan is set at a fixed interest rate for the life of the loan with an interest rate not greater than the Wall Street Journal Prime. Now, we did not highlight in the notice, but really intend is that that fixed rate applies to the guaranteed portion. There is a provision within the notice that allows for different interest rate structures between the guaranteed and unguaranteed portion. So just to make sure you're aware of that. But all other loans, so loans other than a fixed interest rate, would qualify for an 80% guarantee. And I'll talk a little bit further here in a couple minutes as to the guarantee, the kind of provisions of the guarantee. Of course, the interest rates are negotiated between lender and borrower. And the loan terms, our notice sets up the loan term not to exceed 40 years, but there's additional guidance within the notice that really looks at the use of the loan funds, the collateral, and of course the borrower repayment ability to establish the loan terms. The loan terms cannot exceed 40 years. Okay, next slide, please. Again, a couple of highlights, and then we'll drill into some more of the detail. So again, just to emphasize that the program is not limited to rural. It's anywhere in the US. Many of our guarantee programs have a guarantee fee that we would charge. So at the time we issue the guarantee, there could be a fee associated with that. This program does not. So USDA is not charging any fees for this program, either a guarantee fee for the one time or the annual renewal fee for the program. So it's fee-free for USDA. We do establish some collateral requirements, and we'll walk through that a little bit when we go through the application phase of this. I want to note that the guarantee that we're issuing is to the term loan. We expect that many of the projects are going to have construction related to them. This program is able to issue the guarantee prior to the construction project or prior to completion of the construction project. I just want to note that the guarantee is to the term loan. So as long as that term loan is set up like in a multiple draw structure, we could work with a project that is undergoing construction, multiple draws over a time period, could be an interest-only time period during that construction process, and then the amortization of the loan is scheduled. Just note that so there's some flexibility in how to structure loans up for that upfront during the construction process. But the point is that the loan itself, the note, must be a term note. We don't work with projects that issue a construction note or an interim loan and then convert that to a term loan. So it's just the term loan that we're able to guarantee. And just to also highlight that lenders can participate or basically sell or assign all of the loan or the guaranteed portion of the loan. And I'll walk through a little bit more detail as to how that works and the advantage of doing so both to the lender and the borrower. Okay, next slide, please. So we know that some of the lenders participating in the webinar today maybe aren't that familiar with our guaranteed programs across RD. So I thought I'd just step back a little bit and provide just a little bit of insight into the guarantees. And this slide starts off with what we refer to as the full faith and credit statement. So really this is what the guarantee is. So it's a guarantee represented by the US and it's backed by the full faith and credit of the federal government. The guarantee is to any loss sustained by the lender on the guarantee portion of the loan, the principal, and any protective advances or liquidation of the loan. So it's, again, we would guarantee the lender against loss on the loan. If the lender sells or assigns part of the loan, the guaranteed portion, to a holder, then our guarantee goes to 100% of the principal and interest of that holder or holders. And we'll walk through a little bit as to some options as to how to structure that. Okay, next slide, please. So looking at the guarantee program, as to what we hear from lenders as to some key advantages, reasons to look for a guarantee in a program. Of course, the types of projects, again, that we're looking at in this program could vary in size considerably. And some of those projects may be loan amounts that would typically exceed a lender's legal lending limits. In a guarantee program, the guaranteed portion typically would not count against the lender's legal lending limits. So with the guarantee in place, you're able to continue serving customers that you now have, or new customers, with significantly larger loan limits. Again, I mentioned that the secondary market, the guaranteed portion of the loan can be sold on the secondary market, can be participated out to other lenders. So there's a lot of flexibility in recapitalizing and looking for some opportunities in either secondary market or with that guaranteed portion. We see lenders we expect with this program, but what we definitely see with our other programs, the business and industry and our energy programs, are able to sell the guaranteed portion at a premium on that sale. So basically they're receiving, in some cases, a 10% premium for that, basically, the future repayment stream on that guaranteed portion. Some lenders also basically are able to sell or assign an interest strip, so the interest separate from the principal collection, and are, of course, also typically would charge the holder a servicing fee. So there's different revenue streams or ways of lenders being able to increase their return on their investment through the guarantee program. Of course, the guarantees would also assist in mitigating risk. As I noted earlier, our guarantee is against loss to the lender. Many lenders will look at the guarantee as an opportunity to, again, protect themselves. They may maybe have some challenges with meeting some of their credit standards, where it's kind of within the limits, but maybe at the edge, particularly on these types of projects where it might be some specialized collateral or other activities. We think the guarantee does offer lenders opportunities to pick up new business, either new clients, or many of these businesses will have some significant cash flow. Of course, they'll need banking services on. And of course, the guarantee is also, depending on where the projects are located, could meet the Community Reinvestment Act requirements. And typically, our guarantees are of local banks, commercial or local community lenders working with local businesses. So again, that's some opportunities, for lenders to access the program. And I'll flip to the next slide and speak a little bit as to lenders providing credit enhancements to borrowers. Again, typically we would see with a guarantee that a lender may be able to, again, push the repayment terms to kind of the upper limits of the type of project kind of within their credit standards. So you usually would see a little bit longer repayment term for borrowers. Our guarantee requires that the note itself be fully amortized. In other words, we do not guarantee loans that have a balloon payment. So it's not a real estate loan with a 30-year amortization, but on a 5 or 10-year note with a balloon. That the guarantee cannot do. If it is a 30-year amortization, the note itself must be written so that it matures in 30 years, fully amortizing. As again I mentioned earlier, is that with the guarantee, many lenders are able to write loans at higher loan amounts. And also with the guarantee, of course, if the government is guaranteeing the lender against risk, against loss, for 80 to 90% of that loan, when you're pricing that loan, typically lenders are able to offer much competitive interest rates to their borrowers. So again, just some thoughts as to maybe how to structure credit or provide some credit enhancements through the guarantee programs. Okay, next slide, please. Okay, I'm going to do is turn over to Jeff Hudson. Jeff is our lead in really helping stand up the program, working with lenders, answering questions. So Jeff's going to walk you through a little bit more of the detail of the program itself. Okay, Jeff, I'll turn over to you.
I think Mark's overemphasizing my involvement, but here we go. Eligible borrowers must meet the following criteria. The entity must be organized and operated on a profit or nonprofit basis, an Indian tribe on a federal or state reservation or other federally recognized tribal group, a public body, an individual, or a cooperative. Cooperatives are definitely eligible for this program. A business engaged in or proposing to engage in either directly or through contractual lease or service agreements with another entity whose entities, including affiliated entities, in aggregating, processing, manufacturing, storing, transporting, wholesaling, or distributing food. This line comes up periodically through the notice. It's one of the primary lines we're using. Again, really trying to hit who's eligible for the program in this paragraph here. A business engaged in or proposing engaged in commercial food projects either directly or through contractual lease or service agreements with another entity or entities included affiliated entities. Borrowers engaged in or proposing to engage in processing of meat, poultry, processed egg products, and catfish must comply with the requirements of the USDA Food Safety Inspection Service, or FSIS. And borrowers engaged in the processing of other foods and food ingredients must comply with the requirements of the Food and Drug Administration, or the FDA. Let's go to the next slide, please. Eligible uses of loan funds include, but are not limited to, loan funds must support the startup or expansion of activities in the middle of the food supply chain, particularly the aggregation, processing, manufacturing, storage, transportation, wholesaling, or distribution of food to increase capacity and help create a more resilient, diverse, and secure U.S. food supply chain. Purchase and development of lands, buildings, infrastructure would be an eligible activity under this program. Obviously, purchase of machinery and equipment, including but not limited to manufacturing systems, information technology systems, and commercially available new technologies that promote worker safety or food safety. Startup costs, working capital, inventory, and supplies in the form of a permanent working capital term, and supplies in the form of a permanent working capital term loan. We do have a refinancing component in this program. It comes back to the no more than 50% of the funds of a loan may be used to refinance existing debt subject to conditions. And those are again listed out in the notice. We have cooperative stock, the purchase of stock in a business by employees forming an employee stock ownership plan, or an ESOP, or other worker cooperative, and loans to fund the investments primarily in cooperatives. Next slide will go into some more details on the co-op involvement in this program and the co-op stock purchase. And lastly, I cannot leave out the new market tax credit structures. And again, we'll cover that in a later slide. But again, new market tax credits are going to be eligible in here. Some of the things that we've been seeing, some of the questions that have been coming through on some of these eligible and ineligible things, probably one of the top ones has been our hydroponics, aquaculture, greenhouses eligible for the program. And that answer is, on the production side, no. We're taking a look at the hydroponics, aquaculture, and greenhouses, and the growing part of it, and the facilities to grow whatever the produce that would be growing there, or the fish, not to be eligible. Activities after the processing, aggregating, storing after the product is growing could be eligible. So it's going to be, again, project by project specific. Another common questions come through is retail grocery eligible for this. Again, retail grocery is not, it's at the end of the supply chain. So we have on the beginning end, the production ag side, which is not eligible. And at the end side, we have the retail, which is not eligible. And then we'll talk about this later on in the presentation, but there's also the ability for lenders, once they're approved in the system, to be able to submit a preliminary eligibility review, but we will talk about that on a later slide. We will go to the next slide, please. And we're talking again, as I said, next about the cooperative stock, cooperative equity. Cooperative business entity assisted must be an eligible borrower under this notice, and the funds must be used for eligible uses of loan funds under this notice. And loans for the purchase of cooperative stock by individual farmers or ranchers in a rancher cooperative. loans to a fund that invests primarily in cooperatives, and loans to worker-owned cooperatives or ESOPs. Again, the caveat here is leveraged loans to a cooperative, and that's the total of equity loans and leveraged loan to a cooperative cannot exceed 40 million. And we're talking about a leveraged loan is if USDA is loaning, making loans to buy stock, and then the cooperative is also a borrower, could also be a borrower in the program, would be an eligible borrower. The aggregate exposure between the stock loans and the leveraged loan cannot exceed $40 million. Mark, is there anything you want to add to co-ops that I missed?
No, I think that's great, Jeff. If we do have lenders in the audience or other stakeholders that are interested in more detail, particularly on the loan to a fund that invests primarily in cooperatives, that's something that we have that provision within our business and industry program, but has not been utilized yet. We do have a couple of investors, a couple of lenders that we're talking to about trying to stand something up. If others are interested, we're glad to connect and hold some one-on-one discussions, really on any of these as far as it relates to the co-ops. So.
I believe we're ready for the next slide.
And I'll try to drill a little bit into the new market tax credit structure. Again, without going too deep, we thought that including new market tax credits as an opportunity was important to this program, simply for the opportunity to bring in that equity, the equity that this program brings. There are three different ways that a guarantee through the food supply chain could work with new market tax credit, and I'll just walk through those quick. But the similarity of all of these is that we'll refer to the qualifying business. So basically the business or the project that's being assisted, both through the new market tax credit, must be an eligible borrower and an eligible purpose under the food supply chain loan guarantee. So really what we're doing is allowing or enabling funds to flow through the new market tax credit structure or alongside the structure, but all the purposes, the provisions of the program must be met by the actual business, the project kind of at the bottom, that's being assisted. So I'll just walk through the three different ways this could be partnered with the new market tax credit. The first one listed on here is a direct loan to the business, to the qualified business. And when we say a direct loan, we mean it's the community development entity, the CDE, that really has that new market tax credit allocation. So there's a lender kind of in the middle of the structure lending to the qualified business. That loan could be guaranteed by this program, by the food supply chain program. That is, if the CDE is an eligible lender. So it's a CDFI or some associated with another lender that has gone through the application process, the qualification process for a lender under a guarantee. The second way that this, and we've seen more of these going to number two here, is where the food supply chain guarantee is to a commercial lender, to what we refer to as a leverage lender. So basically it's an affiliate of the project that is the borrower, and then funneling the funds, the food supply chain guarantee loan funds, through the new market tax credit structure down to the project. And again, that's typically an affiliate of the borrower that is doing that. So there's the business itself in one way is the borrower at the top, but also through the food supply chain program. Again, the business that's being assisted ultimately must be an eligible borrower, and the use of the loan funds must be eligible under this program. It would also be clear that the loan that we're guaranteeing, that the program is guaranteeing, that is flowing in through the market tax credit structure, all the loan funds must be basically traceable, down to the business, and all the loan funds must flow to the business. The repayment basically is then the opposite, is the business basically repays, back up through the new market tax credit structure, and then back to the commercial lender. The third example is what we refer to as more of a companion loan. So in many cases, the new market tax credit are used to finance longer term type projects. So typically it's the real estate side of a project development. There may be equipment or other expenses or other capital needs of that business outside of the new market tax credit structure. And again, this program could be a guaranteed loan basically to the equipment or to the operating company, alongside kind of a companion loan to the new market tax credit structure. And one thing we did not mention is Jeff went through talking about the loan funds, the use of loan funds, what's eligible and what's ineligible. As he mentioned, we do have some other programs, so our business and industry program, for example, or our Renewable Energy for America program that offer guarantees. Could be to similar entities for similar projects. If there are activities kind of within the project that are not eligible for the food supply chain, we could look at stacking, kind of utilizing other programs alongside. So our business and industry program maybe could be used to finance or to guarantee financing on the production ag side for the controlled climate environment type ag projects that Jeff was talking about, or the aquaculture projects. Likewise with maybe some of the retail side or activities. If there are other needs that this program cannot meet, we're glad to entertain opportunities for other programs. So with that, I'm going to turn over then the next slide over to Aaron, I believe, Aaron Morris. Aaron is the director of our guaranteed loan programs, and Aaron's going to talk a little bit about the application process, the intake application requirements. So Aaron, I'll turn over to you.
Hey, thank you, Mark. Appreciate that, and happy holidays to you all who are joining us today. You've kind of gotten the nuts and bolts of the Food Supply Chain Guaranteed Loan Program. Now I'm going to go over the application process. As Mark mentioned, we're able to accept applications already. I think we're 1 week into the notice of being published, so we can accept applications, and we will be accepting them on a continuous basis. As long as funds are available, as it's stated in the notice that went out last week, we'll be taking applications, so you can start submitting them now. Lenders can complete either a request for a preliminary eligibility review or a full application. If there are questions about structure or eligibility of a project, I encourage you to submit a preliminary eligibility review. If you are thinking about taking out interim financing, you must submit a preliminary eligibility review prior to closing that interim loan, or you need to submit a full application, one or the other. But you need to notify the agency through either a preliminary eligibility review or a completed application that the plan is to take out interim financing for a project. But prior, get this is key, prior to closing that interim loan. Environmental requirements, all applications for the Food Supply Chain Guaranteed Loan Program will be subject to our 1970 regulations. And basically that says you must be in compliance with the National Environmental Protection Act, or NEPA. We encourage you to submit a completed application at the time that you're submitting, including an environmental. But if you think there's going to be a long review time for an environmental, or if this is a complex deal, you can submit the environmental early. We will accept those in advance of the rest of the application materials, hopefully to kind of streamline that process and review both simultaneously if we can. And lastly, a feasibility study will be required for all applications. This includes for our existing businesses as well. We require that there's some type of expansion in each project. And so we would like to see a feasibility study to understand, get a better understanding of what those operations are and what we're expanding into. Next slide, please. Your credit evaluation. Those 5 C's of credit should look familiar to most of you out in the audience. What we'll be relying on is the lender's credit evaluation, as we will be doing a review of that to make a determination to award the loan note guarantee. Unless there are specific requirements under each of these 5 C's of credit, we're really going to be relying on you and your standards at your lending institution. Next slide, please. Here are our capital and equity requirements. There's 3 ways to meet those requirements. The first and probably the most common will be just simply balance sheet equity. That balance sheet equity is 10% for an existing business. It's 10% for businesses with sales contracts adequate to meet the debt service and the term of the sales contract. So if you've basically got feedstock and offtake agreements already in place, it will be a 10% balance sheet equity requirements. New businesses, we're requiring 20% balance sheet equity. And for new businesses that are requesting the guarantee prior to construction, it will be a 25% balance sheet equity. Another way to meet our equity requirements is owner contributed capital as a percentage of the total fixed assets. And so if you've already previously contributed significant capital, and it's at least 10% for our existing businesses of the total project costs, we can use that calculation to meet our equity requirements for this program. And lastly, borrow investment as a percent of the total eligible project costs. And it's basically the same as the percent balance sheet equity. Those requirements are the same, with the exception of new businesses. We'll require that borrow investment will be 25% for all new businesses. So, for example, if for a new business, if it's a $10 million project, you don't necessarily have the balance sheet equity, but the borrower's investment is around 2.5 million, that would be acceptable for this program. And lastly, for all projects above 25 million, and we can have a maximum loan amount of $40 million for this program. Anything above 25 million, we will require additional equity or capital than what you see here on the screen. And that will be on a project by project basis. We'll just evaluate, work with you to evaluate what the risks are and how much additional equity will be required. Next slide, please. Our application intake process, all loans are going to be submitted through Microsoft Teams. Each lender will be required to acquire a level 2 e-authentication to receive access to our Microsoft Teams application intake platform. You see the link here to request e-auth access. You must get that. So if you think you're going to be submitting an application in this program, level 2 e-auth is a must. We are only accepting those applications through Microsoft Teams. In addition, many of you, I'm sure, are familiar. You have to register in SAMS. That link is there at sam.gov. So you get registered with DUNS and get a UEI, and that is a unique entity identifier number. Those, again, that's at no cost as well. And then enrollment for Microsoft Teams, excuse me, there's an active link there. And if you're having trouble with that, please feel free to send us an email at rdfoodsupplychainloans@usda.gov, and we can be sure to get you a form so you can submit that to the agency. Next slide, please. Issuance of the conditional commitment. Our conditional commitment is the agency's commitment to honor the proposed project and move forward with issuing a loan note guarantee should these conditions be met. Those will be handled here at headquarters at our national office. We will review the lender certification that all conditions have been met. So that'll be done here in Washington, D.C. Also, the national office will be issuing the loan note guarantee as well. Since all applications are coming here to the national office will be handling issuance of the conditional commitment and the loan note guarantee. Servicing these loans, you will find instructions to service these loans in 7 CFR 5001 subpart F. That 5001 regulation is our 1RD regulation. I think we might have a little conversation about 1RD at the end of this, but you will find our servicing instructions there. And for routine servicing, our state offices will help out and chip in with routine servicing requests and to collect project performance reports. If you read closely in the notice, we will be requiring performance reports on these food supply chain loans for the first 3 years of the project, just to see how things are going. All of the servicing requests should be sent to the national office. I think that concludes my presentation. I'm going to turn it back over to you, Mark.
All right, thank you, Aaron. And why don't we go to the next slide? And I'll just highlight here again in the, well, first in the drop, if you look at the menu box, there's a handout drop down. If you go to the handout, you'll be able to download a copy of this presentation. If you go to our program website, Again, here's another active link to that website. That website provides additional information about the program, the fact sheet. There is a link directly to the Federal Register notice. Again, that's basically the rules, regulations for this program. We're continuing to update a frequently asked questions page. So as we receive questions come in that tend to be a pattern or of a common area, we're going to keep updating frequently asked questions. So feel free to connect and check with that. As Aaron just walked through the enrollment process, again, that is highlighted in our webpage, along with access to the systems and to the forms that you need for that. There's additional application guidance for lenders and borrowers, including there's a guide for a feasibility study of what should be included in the feasibility study. Again, we encourage you to take a look at that. It's also set up under the borrower guidance. And as we hold additional events, for outreach activities, webinars, we'll be posting those to the page under the events tab in a recording. So the recording of this webinar will be posted up to the events tab. So if you want to go back in and listen to a piece of it or all of it again, feel free to do that. I do want to mention that occasionally here we reference other guaranteed programs. So within rural development, we have an initiative that we call the 1RD Guarantee Loan Initiative. That program covers 4 guaranteed programs. It's the Business and Industry Program and the Rural Energy for America program, 2 programs under Rural Business Cooperative Service. We have a guarantee for community facilities, and that is through our rural housing service, but for nonprofits, public entities, for essential community services, healthcare, education, fire rescue, safety. You have a wide variety of purposes there. And we also have an infrastructure guarantee for water, sewer, and waste disposal for rural communities. That is through our real utility programs. But again, all 4 of those programs are administered under what we refer to as the 1RD guarantee. So here's a website for that. Many of you I know are involved in those programs. So you'll see a lot of similarity between those programs and this one stood up. But again, if you others that would like information about those programs, feel free to take a look through the website. There's also an email box, a contact box there for additional information. For those of you that are involved in other guaranteed programs, we do need you to go into the process that Aaron just referred to enroll for this program, because we're taking applications in through the kind of Teams environment. That is basically going to set up then a team page for the lender that's enrolling. So that's what we need your enrollment to go through that. Once you have that, we will be able to also leverage that into lenders that work across states for our other programs, but we're looking at that as kind of a rollout over time. So we're going to start with your engagement in this program as far as the online system. So with that, I think we're ready to go through. Actually, why don't we go one more slide? I think the next one has contact information for a lot of us that are presenting today. So I thought we'd maybe just kind of rest on that as we take a look at the questions and go through. But again, a reminder, if you have questions for follow-up here, just go ahead and go into the questions chat box and type in your question. If you think it's a little bit more of a nuanced question or want to walk through it orally, I think we have the ability to raise your hand and we'll call on you to walk through those. And again, if you do have some very specific one-on-one questions, the website I missed on there, does have a contact box, contact us. So there's basically a very simple form. Is you just put your name, your contact information, and your question, and it'll send it into us to address for you. Or if you want to reach out directly to us, we're glad to take questions and discussions with you that way. But why don't we kind of roll through a little bit of kind of the questions that have been entered so far. And as we do that, Taylor, also, if you want to let us know if there are any hands raised, we'll circle back to that. But first of all, why don't we talk, I know some of the questions maybe came in as we were going through some of the discussion, but we'll kind of go through these and maybe readdress or trying to kind of broaden or just circle back to some of the details. But Jeff, you want to walk through again as to when we're looking at we're referring to the middle of the food supply chain, kind of what's eligible, what's not. There were some questions in the chat regarding transportation, storage, maybe facilities that maybe have multiple purpose, serve different types of maybe supply chains, including the food supply chain. How do those fit within the program?
As we take a look at it, the reg doesn't, or the notice doesn't get exactly to the detail there, but we would be taking a look at that based either on a percentage of revenue or a percentage of square footage being used in the actual food, in the middle of the food supply chain use, and having the lender being able to justify that loan amount and what the other income streams would be, and we need to be seeing an increase in some type of output in the middle of the food supply chain.
Okay, so the increase is critical. It could be different ways. I mean, we've obviously I think the project is going to look at increasing capacity through basically increasing their footprint, either a larger process facility, more storage. However, there may be some facilities that can upgrade their systems, maybe using more efficient systems, maybe more robotics or higher technology systems, and through those new systems increase their throughput. That also would be a way of increasing capacity and be eligible for the program. So again, we're looking at as much flexibility as we can as to needs of projects to increase capacities to serve the food supply. A little bit, maybe Jeff, on structuring of loans. I maybe didn't do a good enough of a detailed job talking about structuring of construction projects, of the loan closing, being able to basically work with loans or with projects that are financing construction and the term loan combined. Can you maybe just address that again as to how that works?
The food supply chain, or the FSC program, does allow for us to issue the loan note guarantee prior to or during construction. But again, we are the guarantee program, and similar to our other guarantee programs, the guarantee of the note. So if a construction or construction loan is being used that's going to convert to a term loan, we don't have the ability to guarantee that construction loan. If you're using a multiple draw note that converts to the term note during construction, we would be able to provide a guarantee on that construction loan at that point in time. I think that's the question that I'm trying to hit, right, Mark?
Yeah, I think you're right. So the point is that the guarantee is issued to a note that is fully amortized. Fully amortizing. Could be multiple draws, could be a interest-only period up front to address the construction period. There are some, I know there are some limits to that. Maybe Aaron can address a little bit as to when we're looking at starting principal and interest payments in that construction period. Can you provide a little detail there, Aaron? You're on mute. Oh, yeah.
Would help if I took the mute button off. So during the construction period, we can look at up to 3 years principal and interest. What we're looking at is the borrower's ability to repay during that construction period, as well as the facility's ability to generate adequate revenue to support the debt at that time. So those are reasons to provide an interest-only period. Again, it can be no longer than 36 months, but we do have some flexibility there.
Right, there were some questions about use of loan funds, a little bit on refinancing. This program is able to include refinancing. However, the refinancing cannot be a majority use of loan funds. It has to be, the majority has to be for expansion, for either real estate improvements, equipment, other basically new money for expansion, increasing production. If the refinancing is needed for improving the cash flow of the operation, obtaining a lien position on the real estate, there are again a couple of examples kind of written within the notice as to when refinancing can be included. But the total is that the bottom line is that refinancing, while included, cannot be a majority of the use of loan funds. I think there were some other questions here as far as like transfer of ownership, as far as use of loan funds. and also maybe a little bit more as to the egg production, as to there was an example of an egg laying operation. But Jeff, can you address that a little bit in a little more detail?
Sure. On the transfer of ownership, I don't believe, unless that this would be a program that would be effective in transfer of ownership, because again, we're looking for some type of an expansion in the food supply chain, and transfer of ownership, unless there's something else associated with it, would not be providing that increase in production in the middle of the supply chain. As we go to production agriculture, on the egg laying side, actually, hopefully I get this one right, I've always used this as an example from my program director days, is we really can't finance anything on the laying side of the operation. But once that egg gets to the egg washer, then it could become eligible for the food supply chain. Anything after getting the egg to the egg washer forward, whether it's cold storage, packaging, cracking, something like that. And again, it's simplistic, not simplistic, but easy with the egg. You can visualize the egg washing, that have the egg on one side, washed egg on the other, and that's where that line starts. And the rest of production ag, again, it's going to be once the agricultural commodity has been harvested and start to process, is where the food supply chain would become eligible at that point in time. So while we may not be able to pay for the hydroponics or the greenhouses, once they start washing, packaging, refrigerating, the aggregation, storage, value-added processes, that should be eligible. So Mark, am I covering that question where you wanted me to cover it at?
Yes, I think so. I think very good, very good.
I understand eggs.
Yes, let's roll through the questions and see if there are other common related there. I think we're doing good there. On the, especially meat and poultry processing, Jeff, as far as meeting USDA FSIS requirements, you want to walk through that a little bit, if there are state licensing versus USDA licensing, as to how that may work?
Again, the notice goes to anybody involved in meat and poultry processing needs to be at meeting the FSIS standards. There are some co-op agreements among states where the states have the ability to provide the USDA type of inspections, and that would be eligible if they're in a co-op agreement. But as part of the project, getting to participate in the food safety or to participate in the food supply chain program, they would need to be stepping up to an FSIS inspected facility if they are not already there.
Okay, very good, very good. Aaron, do you want to readdress as far as the feasibility study, the need for it, when we need it, and maybe the scope of a feasibility study?
Sure, Mark. Feasibility studies are going to be needed with every application. Again, we're requiring some sort of an expansion with feasibility studies. So we want to look at the markets that you're potentially expanding to, any contracts for sourcing the product, opportunities to sell it, what that market looks like. Really, the feasibility study should really hit on those components there. And of course, part of a completed application can't have a completed application without the feasibility study.
Okay, so a feasibility study in all projects, but really the scope of it may be a little bit variable depending on the nature of the project, right?
Yep.
Very good, very good. Again, some questions on kind of structuring of loans. If you have loans that are being used for different purposes, let's say a real estate, equipment, and working capital. There was a question as far as establishing terms on that. We have lenders have options. You could write, let's say if the loan is being used for different purposes, you could have separate notes, separate loans, different terms, or you could do a blended note, and then look at the either through a weighted average or a balance, a way of calculating the kind of blended term of those notes. But this program does provide the flexibility for either or kind of within that. How about our favorite topic on hemp, including hemp, CBD, or yes, CBD eligible for this program?
Sounds like a Jeff question.
Weigh in on that?
I thought Aaron was going first.
Sure.
This one's not, but yeah.
So, no, hemp is not eligible. It is not food for human consumption. or I guess it is in some cases, but it would not be allowable for this program. So no, hemp will not be eligible.
In the food added products of hemp, or another defining part of that's going to be on the CBD oil side, is it has to meet the requirements of FDA and being FDA inspected. And I'm not sure that the FDA is there doing that yet.
Right. So there's very good point. Maybe other types of, and we had some questions coming in about beverage, alcohol, coffee, teas. Again, in this program, probably not eligible, right, Jeff?
Explicitly noted in the notice that alcohol, tobacco, and any food supplements are explicitly prohibited from eligibility in this program.
Okay, and Aaron, can you address a bit as far as like the recourse of loans, personal guarantees, and the such requirements for the program?
Sure. Personal guarantees will be required. Personal or corporate guarantees will be required for each loan. Collateral requirements, of course, will be dependent on you, of course, but industry generally one-to-one, discounted collateral coverage. Discount rates should be around 80% for real estate, 70% for machinery and equipment. Talking accounts receivable, other things like that, looking at 60-50%. So those are pretty much standard recourse requirements across the lending industry.
Okay, very good, very good. There are some questions about being able to export food. So this program does not reference as far as where food is, the products are being sold, though it is part of our suite of programs for rural economic development. So if the project is exporting food and food product, that does not make it ineligible. That is eligible within the program.
Mark, I did want to mention one other thing about recourse. We don't necessarily have to be in the first lien position, but the collateral, securing the loan needs to support us not being in the first lien position.
Okay, very good, very good. And again, just to emphasize, you talk a little bit on the personal guarantees. We are following our similar our B&I program in energy programs. So it's ownership of 20% or more. We would require a personal guarantee. So projects that are widely held cooperatives, for example, would not require guarantees or personal guarantees. Again, some follow-up questions on fees as far as charging the guarantee fee, servicing fee, or under our other programs, we have a fee for issuing the guarantee prior to construction. This program does not have any fees, including does not have a fee for issuing the guarantee prior to construction or part of completion of the project. So again, no fees within this program.
It's our Christmas gift to all of you.
That might be hopefully a long-term Christmas gift, right? All right, I'm trying to scroll through a little bit on the questions that are coming in out of Aaron or Jeff. If you see others in here that I kind of skim by, if you think that we did not address, feel free to raise it.
And we do have a couple hands raised if you'd like to address those.
Why don't we do that, and then we can scroll through the questions again online one more time. So yes, please, Taylor.
Okay, first up is Scott Spenny. I've unmuted you. If you take yourself off of mute, we'll be able to hear you.
Hi, thanks for hosting everyone. I had a quick question on one of the credit enhancements that you had listed around full repayment, and I think, Aaron, the comment you made around balloon payments. I just want to make sure I understand. So, as a commercial bank lender, as I think about loan tenor, so traditionally I think we're doing 5-year, maybe at most 7-year kind of deals. Would that mean that I'll just use the example of a 5-year deal, would that mean my amort schedule on the guaranteed portion must also be on that 5-year schedule, i.e. not extend beyond the 5 years? Is that how I should think about that as far as a balloon payment is concerned?
Aaron, you want me to take a shot at it?
Go ahead, Jeff.
One of the requirements in this program, similar to our 1RD program, is we require a fully amortizing note to hit the full term of the loan. So if you're looking to do a 30-year term, we're looking for a note that will be fully amortizing over that full 30-year period. So you can have, if you're using a variably priced model, you can set up a schedule for variable pricing, when you want to reprice the note, but you cannot use a balloon instrument. You have to use a fully amortizing note. Not prohibiting the repricing, you just need to tell us how you want to reprice it and what you're repricing it to during that term. But if you're using any other, if you're using trying to get the 90% guarantee and using the fixed rate option, it's a fixed rate for the full amortization term of the loan. I don't know did I miss anything there, Aaron?
No, I think you hit the nail right on the head. You know, there's situations out there where, you know, you can see a 5 or 7 year note and based on a 30-year amortization and balloon payment due at the end, that would not be acceptable for this program.
Thank you.
All right. Jerry Krieg, I've see that you're in queue. We've taken you off of mute.
Yes, you mentioned that for this program, lenders would need to register or enroll. Could you talk about that process?
Sure. There's a level 2 e-authentication process. We provided that form. There is a handout that's available with this webinar presentation. So I know there have been a number of folks asking about if the slides are available. There is available. There should be active links within that presentation. You should be able to access the form to be able to register for level 2 e-auth. If you're having trouble with that, feel free to email us, RD Food Supply Chain Loans, plural, RD Food Supply Chain Loans at USDA.gov, and we can work with you to get involved in our Microsoft Teams application intake platform.
It's also detailed on the food supply chain website and lender eligibility. There's a handout there that you can print out there if you can't get it through the slide deck. So a couple different options on how to get through the enrollment process. I will say that's probably been the #1 asked question that I've fielded in the past 6 days. So there we go.
All right, another hand raised. Mike Sandusky, I'll take you off of mute.
Yeah, this question is for Aaron. Aaron, I'm still unsure about feasibility studies. Even existing businesses have to have a feasibility study, even if they're refinancing existing debt?
So we limit refinancing to 50% of the total project, or less than 50% of the total project. Right. So there has to be some type of expansion that's happening as a part of that project, Mike. And so whether you're expanding what you're already producing at that facility, where's that new product going? Who's buying it? Can you support that? The labor, that's going to be needed to expand. We would need to see a feasibility study for that.
So even if it's an increase in the capacity that they're already, just increase their revenues on what their existing facility is producing, it needs a feasibility?
Yes, correct.
Okay, thank you.
All right, thanks, Mike.
And there are no additional hands raised at this time.
Okay, I see there were a couple of questions that we skimmed over just to circle back to. So structuring the guarantee. Again, the guarantee itself is either going to be an 80% or a 90%, depending on the interest rate. Again, to qualify for the 90%, it's a fixed interest rate for at least the guaranteed portion for the life of the loan. The lender must hold at least 7.5% of the loan, and that's of the unguaranteed portion. Cannot participate or sell, but the lender can participate or sell all the rest. So typical, the guaranteed portion is generally split off either through an assignment, or we also, as you'll see in the notice, allows for a multi-note structure. But the lender could also participate the unguaranteed portion, other than the 7.5%, to other lenders or other parties. So there's flexibility there. The lender cannot participate or sell to a affiliate or an owner of the project. So it has to be to a third party. But otherwise, it's fairly wide open. There's a very active market, secondary market for guarantees for our business and industry energy program. And from the stakeholders we've talked to would have an interest in this program to work forward. So basically the participation, the assignment pieces, all that mirrors our other programs. We have our own forms for this program. However, the kind of provisions behind those and how those activities work are the same. We have to have our own forms because this program is administered through the notice, not through a regulation. But I should highlight that as to we do have separate forms for this program from our other guarantees. And so if you go into the program website, the forms will be accessible there. But if you go into our electronic form site, again, all the forms will be loaded there for your use to go forward. And they're under the 4281. So 4281 is kind of the series of these forms for this program. Aaron or Jeff, do you see any other questions that we've skipped or came in as we're speaking here?
And we do have a hand raised while you look at that, if you'd like.
Sure, let's go.
Hey, Shane Fee, I've taken you off of mute.
Yes, this was likely addressed when you talked about the no guarantee fee and the construction related fee on the front end. But again, I just want to clarify, with the USDA B&I, they charge the 50 basis point servicing spread on an ongoing basis. We don't have that here?
That's correct, we do not.
And we've actually changed that on the B&I side as well recently with a new rule change. So it's no longer the case with B&I either.
Well, there's a 50 basis points renewal fee, annual renewal fee for B&I. There was a requirement that the lender retain 50 basis points, basically a servicing charge to the holder. That is what Aaron's referring to, is no longer in place for B&I.
Thank you.
Okay. And likewise, this program, if you are selling a loan to a holder, the lender and holder negotiate that servicing charge. We do not set a upper or minimum limit for the servicing charge.
Going through the questions, Mark. Jeff, this one might be for you. Meat processing facilities that are state licensed but not USDA, are they eligible?
I'm struggling a little bit with this one, Mark, because I'm not sure of the answer on that one.
I should be able to chime in on that one.
Go ahead, Karama.
Yes.
Thanks, Dr. Neal.
Sure. Yeah. No. So the state licensed projects that abide by USDA guidelines, they've gotten an exception to do that through the state. They have the same types of guidelines that the USDA guidelines are. They just have a different process through which they meet those guidelines, and those are eligible through the state. But it's not eligible as like a custom exempt type of project. Whatever your licensing is, if it's not meat and poultry and it's done through FDA, then you need to be able to show that FDA inspection as well.
Okay, I think that should cover. Very good, thank you. Let's see another question I was going to address.
Mark, do eligible lenders that are not currently 1RD lenders need to apply first for 1RD?
Yes, so this program, we're using the process that's in the 1RD. So you'll see in the notice when it talks about lenders becoming eligible for this program, we're using the rules that are in place for the 1RD, the 5001 rules. However, a lender that is, and it's the same requirements, a lender that is under the oversight of a federal or state agency is eligible. You simply need to enroll. Lenders that are basically non-regulated, so maybe working with a license or other lending practice, but not regulated by a federal or state agency, those are the lenders that need to go through an application process to support their experience, provide a credit evaluation, and then go through the application process to become eligible in the program. Lenders that do go through that process to become eligible are also eligible then for the 1RD. So basically, since we're using the same processes, once you're enrolled, it would actually be for 5 programs, not just one, going forward. So, but if you're in 1RD now, so you are a regulated lender and you're active under a B&I, REAP, CF, or water and waste, we do need you to sign a new lender's agreement for this program. Again, just because of the slight differences in the program, we have to operate it with a separate lender's agreement. But that's the only extra step, is really that lender's agreement needs to be executed before we would issue any guarantee to a lender in this program. Did you see other parts of that question, Aaron, that I missed, or is that?
No, I think you covered it, Mark.
Okay. Any hands raised?
Yes, looks like we've got about 5 hands raised at the moment.
Okay.
6, it's climbing. First, we'll begin with Pepper Ottman.
Yes, can you hear me?
We can.
Okay, thank you. I am not a lender, so my question may seem a bit simplified, but I have 2 questions. First off, with the loans that may go to tribal entities, if these, how are they in any way guaranteed, especially by second lenders, if the tribal lands are in trust? And secondly, on other loans through the program, if the loans are in fact sold, can that be through the market to where it could be out of the country loans, and that collateral still be private property and things like that? Thank you.
Okay, I think I'll maybe start with the first and have others kind of pitch into as we go through. So the as far as financing of projects on tribal lands, reservations are eligible. The lender will need to, and the loan will need to meet the, the lending standards, of course. So it is possible to take basically a lien on trust, not on the land itself, but on real estate development or other assets, also depending on how it's structured. So again, that's something this program definitely can do. That it is trust land should not impact our ability to guarantee the loan, at least not from our perspective. It would maybe the lender would of course need to have basically a comfort level and I think some expertise in lending into those types of structures. We do have lenders that are engaged in guarantees on tribal lands. So we always could, if you're looking for a lender that has that background, help you connect with that. As far as the guarantees and collateral, again, when we're talking about selling the guarantee, it's really an interest in that note. So the lender always holds the note, always holds the collateral, and is responsible for servicing, collecting payment on the loan. And basically what they're doing is assigning an interest in the guaranteed portion through the secondary market. So it's not like some other products, maybe residential or others, where a lender actually sells 100% of the loan and a new lender takes that loan. That's not what we're referring to in this program or other guarantees. We're talking about a secondary market transaction. It's really selling an interest in the guaranteed portion, so assigning that interest. I don't know, Jeff or Aaron, do you have other thoughts to add to? I know there are a couple of questions that were kind of embedded in there, but, or if we missed any of the questions, the questionnaire can maybe remind us of what we missed.
No, that covered a lot of it. I'm just generating a lot of questions and getting answers as we go through this. It's very interesting, and I'm glad to be able to participate today. Thank you.
Well, thank you for joining. Yes. Taylor?
All right, and next up, Shane Fee.
Yes, regarding the construction again, Mark, you indicated how that might be handled. Could you walk through that again?
Sure. So let's say a loan that is financing construction, the loan itself, so the term loan and our guarantee, could be issued prior to starting the project. Typically, we would expect that if there's any equity or other funding coming into the project, the borrower would use those funds first, then start drawing on the loan that's guaranteed, so your loan. That can be dispersed over a period of time. The guarantee would be in place for any principal that's advanced. You would have to at least be collecting interest, on the principal that's outstanding, ongoing. We would have to have the loan would be fully scheduled. So if the borrower, let's say it's estimating a 1-year construction period, maybe a 6-month ramp up. So after the loan itself would show advances over the 1 year. At least that would be your plan schedule, interest due at the end of that year. The borrower ramping up their production, maybe starting principal payments, 18 months or 2 years in, depending on how fast the ramp up is. But then from there on, that note shows a full principal and interest payment going forward. So it's kind of structuring for that build up, the construction period, the interest only, ramping up payments up to a full payment and then fully amortized. So that loan is structured that way at the day of closing. Does that help?
Yes, sir.
Does that help? Okay, great, thank you.
Next, I see Laura Buxbaum.
Yeah. Yes, hi, can you hear me?
We can.
Great, thank you. You addressed this question, but I still don't quite understand, so I apologize. But if you are a CDFI, non-regulated lender, and not currently a guarantee, one RD guarantee approved lender, do you go in through the 1RD process, or is it a separate process through teams? And then can you also then qualify to be a 1RD guarantee lender for, say, BNI? I just didn't quite understand the process, like what the portal is, I guess.
Mm-hmm. Okay, sure. So a lender that's not a regulated lender and not already engaged in other guarantee programs with us does need to go through an application process. We're using the same process for all our programs. So the 1RD process is what we're using here. So a CDFI that's not under the supervision of a federal or state agency would need to go through that. So submit the application to become an eligible lender. That comes in through the 1RD regulation addresses that intake and how to go through that application requirements. A lender that then basically meets that requirement and is determined to be eligible, then will be eligible for the 4 programs under the 1RD and the food supply chain if that's what they're applying. That's what they're requesting. They become eligible for all 5 at one time. It's just that then when you want to start submitting applications, that's what that Teams portal is for, is to then get set up with basically it's a guest page within our Teams site, and each lender then would have kind of their designated page in files to work of submitting information.
Thank you so much for clarifying. I appreciate it.
Very good, very good. And again, for lenders that are under the supervision of a federal or state agency, you don't need to go through the application process, but you do need to submit the request to enroll in the application system. Okay, Taylor?
Yes, we have one more hand raised, and that is Billy Cannon. Billy Cannon, if you take yourself off of mute, we'll be able to hear you.
Okay, can you hear me now?
We can.
Okay, great, thank you. The one question is, I have a prospect, a customer that had a feasibility study done about 18 months ago. How current does a feasibility study need to be to qualify for the guarantee program? Is there a timeline, I guess is what I'm asking.
Yeah, that's a good question, and I'm sure we have not addressed that. I would just look, given the times we're in, I think we'd want to see at least maybe an update or a response back from whoever signed off on the feasibility study, maybe addressing that question as to what has changed. Especially in the, well, both market cost. I mean, there could be some significant changes, but we at least want to have your consultant address.
Yeah.
You think, Aaron?
No, I agree, Mark. Just kind of want to see, I mean, if the conditions that were in place 18 months ago are the same as they are now, that could be the case. So getting that provider to sign off on that, stating that should be acceptable to the agency.
Okay.
All right.
Go ahead.
We do have some additional hands raised. And George Thompson, third.
Hi, can you hear me?
We can.
Okay, I just had a question. If a potential borrower has an existing loan through the USDA B&I program, a loan guarantee, can they also receive a loan guarantee through this program if they're otherwise eligible? So they'd have 2 USD loans on their books?
Yes, sir, they can.
Perfect, thank you.
And I'll add to that the maximum loan amounts apply to each program separately. So under this program, it's a $40 million for the food supply chain, and B&I is $25 million for the B&I program. So if their needs required and eligibility enabled, we could combine those two and have up to $65 million of loan guarantees.
All right, and there is one more hand raised at this time. Jim King.
Yeah, so can you explain a little more the feasibility study and the environmental study? Are there outside entities you need to hire to do this? Is it something a borrower can do themselves?
We do require a third-party independent feasibility study for every loan. As far as environmental, a qualified environmental consultant needs to undertake those activities for the agency's review. So all of these, yes, third parties.
Thank you.
Yeah, so for the environmental, it would depend a little bit as to the extent of the review. We may have some projects that are not construction, maybe changing out, updating equipment, other activities. If there's not any ground disturbance involved, that might be something that the borrower and lender are able to provide as far as the environmental information directly. But if there's construction, any turning of ground involved, particularly in a greenfield, is where likely we'll need a third party to help through the environmental, gathering the environmental information. But we do have a support staff at the field level that can work with environmental reviews. If you have any questions on that, it does vary a little bit from state to state, simply due to contacts, depending on where the project is, kind of what the environmental resources or concerns might be. But again, our expertise at the field level, our rural development field office level, can also help with any questions you have around those issues. Okay, there are maybe a couple that we can circle back to. There's one regarding third parties. Let's say third party real estate development. So a real estate owner, maybe a real estate holding company doing the real estate development, and then either leasing to or working with an operating and maybe third party. Is something like that eligible, Jeff?
Yes, it is. As long as the ultimate use of the facility is going to show in some type of an increase in the middle food supply chain, it would be eligible for the program. But again, need the third party independent feasibility study that speaks to who's going to be the lessee of the real estate.
Okay, very good, very good. Yeah, we do, just a reminder, include that nonprofits, public entities could be eligible borrowers, and that's where there may be some possibilities of, let's say, a facility that's being developed by a third party or a public entity, maybe as a multi-tenant facility all around food and food processing. Again, that type of structure could be eligible. So it's, if we look at the regulation and even our slide that we talked about use of funds and eligible borrowers, We talk about businesses that are directly involved or indirectly involved, either through contracts or providing services to the food supply chain. So either direction would be eligible within the program, and that's throughout the food supply. So it could be warehousing, it could be other activities where there's a real estate owner leasing, contracting to someone engaged in the food supply chain. Okay, Aaron or Jeff, did you see other questions that we should address or haven't addressed?
There's one in here, Mark, that it's come through, I think, a couple times on the eligibility, and now I'm missing it as questions shift around. Eligibility of grain cooperatives. I'll take a swing at that. Is for purely storage of grain, I do not believe that'll be eligible underneath the food supply chain guaranteed loan program. Storage of grain, if it's going into the manufacturing of food product at a processor, could be eligible, but straight storage and a grain elevator grain cooperative, just as aggregating grain, is not an eligible use under the food supply chain program, but would likely be eligible under our business and industry guaranteed loan program, depending on the location of the project.
Right, very good, very good. I did see some questions as to foreign ownership or foreign involvement in projects. Do you want to address that a little bit, Jeff?
Yeah, again, the reg talks about individuals and needing to be legally admitted, but as we talk about business ownership or corporate structure, foreign-owned entities can own a project. The project has to be domestically located, and again, coming back to the caveat, has to be showing improvement or increase in something in the food supply chain, but foreign ownership does not disqualify, foreign business ownership does not disqualify anybody from applying from the food supply chain guaranteed loan program.
And guaranteed loan funds should remain here in the United States.
Yep, domestically located, yes, located within the United States or the territories. Thanks, Aaron.
Okay, questions regarding it kind of on the borrowing limits, but from a sense of exposure per borrower, maybe guarantor. I think some of the lenders are familiar with maybe our old B&I requirements where we had limits on guarantors and being able to access the program. Aaron or Jeff, do you want to address that
question? I missed that, Mark, sorry.
As far as limits on exposure to a borrower or to a guarantor.
Yep. We have exposures to a borrower are going to be limited in the food supply chain to an aggregate of no more than $40 million, depending on how they come in. Again, Mark discussed this a little earlier. We can stack this with our other guaranteed programs between the business and industry guaranteed loan program and the REAP program with up to their limits of $25 million each. But the aggregate exposure under the food supply chain program will be $40 million to one borrower, to one entity. I do not believe that the notice talks about guarantor exposure.
Right,
no,
so
we are silent on that, and so it's really on a project by project, just depending upon we will expect a global analysis, global project evaluation, global evaluation of the owners, and we'll evaluate that risk on a project by project basis. So there is no limit, but we'll just evaluate the risk as you all see it, as we see it, and we'll move from there.
Right, and there are a couple of questions here that circle around kind of the processing. So again, applications will be received on an ongoing basis, submitted to the Teams, call it Teams portal. Our national office team will basically receive the application. We'll connect with our rural development state office team, but Aaron and team will basically lead the reviews and process forward. There may be some environmental and some other issues or other tasks that we need our field team to be involved in as we work forward. The approval process would be through our national office. Under our B&I program, loans over 25 million need to go up to the secretary. This one does not. So that'll be with in-house. We do have an executive loan committee set up for loans over 25 million. But ultimately, Dr. Neal will be the approval official for the larger loans in this program. So it's a relatively streamlined process in that sense of working with the review and approval process.
Mark, there's a question here on the priority scoring system as similar to the B&I for the application. The notice does outline a priority scoring system. The priority scoring system is only going to come into play as we start to exhaust funds, as we're funding applications on a first come, first served basis. The priority score, again, will not become an issue until we get towards the end of the available guarantee authority. Is there anything you want to add to that one, Mark?
No, perfect, yep. Good. As far as there's questions on, again, kind of loans being assumable, kind of working forward with activities. Again, the loan is the lender's loan. So in the sense of loan itself, of course, could be assumable based on how you structure and what the lender is interested in. The guarantee can be also kept or assigned, tagged to that loan as it's being assumed, as long as the borrower is eligible and the purposes stay eligible. In other words, we likely would not do an assumption, let's say, on a facility that was going to change use. The use of the funds, if it's, let's say, a storage facility, and they're going to change it outside of storage from other than food storage, we would not likely be able to do a transfer and assumption. But it depends on our servicing regulations are pretty flexible. But the bottom line is the guarantee is and can be tagged to a loan that's assumed by another entity, yes.
The caveat to that would be, again, that will require USDA review of the lender request at the time that transfer or assumption is made. So it is a formal request to rule development. It's on a case-by-case basis on the review side.
Right, and we look at it, let's say, similar to a new loan in the sense of reviewing the underwriting of the new borrower, the incoming borrower. So, okay. Jeff or Aaron, any other questions that you see coming in, or Taylor, any hands raised?
There are no hands raised at this time.
There are a lot of questions that we can address kind of on a sidebar or one-on-one. I encourage everyone to use our inbox, the RD Food Supply Chain Loans at USDA.gov account. Please send your questions there. Jeff's been doing a really good job of directing traffic on that and getting folks the answers that they need. So, happy to answer any questions. We won't be approving any loans until early February, so there's plenty of time to get those questions answered. So, appreciate everyone's time this afternoon. Really.
Right. As far as maybe helping with questions, I think we have talked earlier about the preliminary eligibility review process. So if you do have a potential project and really want to drill into some of the issues and questions, feel free to use that. Generally, what you would typically write up for a preliminary review within your own banking needs likely would meet what we would need for the preliminary review. So feel free to start with that. But again, if you have specific questions, yes, fire them in. We're glad to address that. It looked like, Jeff, I thought you were going to add something else to that part.
No, we're doing just fine. Thank you. I was scrolling through questions on my other screen.
Okay. Okay. Yeah, we'll, of course, all our questions will be recorded here. So if we do see something that we really did miss, we'll make sure we reach out. And again, we'll use the questions you have here to help us with our FAQs and providing some additional guidance. So feel free to work with us. We hope that those of you that are familiar with our B&I and other programs under the 1RD, you see that there's a lot of mirroring and leveraging off of that program, or programs, I should say. And for those of you that don't know those programs, if you engage in this, I think, experience the other side as to engaging here will help you, I think, engage with the other programs if you're interested in pursuing forward. Maybe just to kind of close out and maybe stall a little bit more for questions if you have any, but just a couple, again, some highlights or reminders, kind of the differences of this program versus the BNI. Clearly the loan amount, you're going up to a 40 million, whereas it's 25 in BNI. Eligible areas, BNI are limited to rural, along with local foods kind of in urban areas. But this program is in all areas and does not have that restriction of just be local food. So it could be any food supply in urban areas. Those are probably the two biggest differences rolling forward with these programs. Okay, any other hands raised, Taylor, at this point?
No hands.
Okay, how about closing comments? Any from the team? Dr. Neal, are you still on? And I don't have my screen open as to our presenters. There we are.
Excellent. Yeah, no, I will close. I want to just say thank you again to our presenters, and thanks again to each of you who are on this call, who've expressed interest, taking time to learn more about this new program. We're excited about the impact that it can create. It can only be done with folks like you who are on this call now. So again, we're grateful for your interest. We welcome your questions, welcome your engagement. Hopefully you've seen that demonstrated in the time that we've taken to address questions here today. Again, welcome you to email us at the email addresses that are listed on the screen, but also at rdfoodsupplychainloans@usda.gov. Welcome those and look forward to working with each of you. Thanks you again.
Very good. Thank you all.